Stocks to buy for the month of October. Now, of course, I don't know your personal situation or your blueprint. I'm going to share some stocks that I'm buying and stocks that I think are attractive at these prices and lower. So today I added a new position to my main portfolio, my $1.5 million growth stock portfolio. It's a little under that now after the recent sell-off. ACM Research, the ticker on this is ACMR. Now, typically I like to buy stocks that are in a downturn. We'll talk more about that later. I'm going to show you a chart. I'm going to give you some high-level analysis about the company and what it does. You can see on the 52-week range, the low is $5.46. The high was $19.99, and it's trading today at $17.55. Now, this is a small cap. It's about $1 billion market cap, just over that. Short interest is about 5%. Okay, great, but you might not have ever heard of ACM Research, so what does this company even do? In simple terms, it cleans wafers. So this is semiconductor equipment. The idea behind this, you think of Taiwan Semiconductor, they provide equipment to Taiwan Semiconductor. Now, the Arizona plant, the fab, the foundry for Taiwan Semiconductor has been delayed. That's one of the reasons why the stock's been selling off. There's also been some insider selling, which, the market never likes. The stock is also, of course, ripped from lows, and so there's a lot of profit taking. The big risk here, I think, is the China exposure. So I said earlier, essentially, they're cleaning wafers, helping clean semiconductors, right? So it utilizes megasonic acoustic vibrations through a fluid bath to produce bubble oscillations, which assisted with cleaning defects. Now, this is specific to one tool, and there are several tools. I'll go to the website here and show you a breakdown. This is actually an investor deck from Investor Relations at ACM Research. So at a glance, best-in-class multi-product semiconductor capital equipment supplier to leading global semiconductor manufacturers. It has differentiated technology, improves customer production process with better yields and reduced chemical consumption. Over 448 patents issued in the United States, China, Japan, Singapore, South Korea, and Taiwan as of the end of 2022. Now, ACM Research has state-of-the-art production facilities in China, and that is a huge issue, especially if we think of the United States and we're trying to push China out. If we create more legislation that makes it restrictive, that could certainly impact the stock, so you have to be careful with that. The company is headquartered in Fremont, California, has 1,200 employees globally. So you can see they've got the cleaning equipment here, they got the ECP furnace and other new products, and then advanced packaging and other. Looking at some of the financial highlights, this is total revenue. It goes back to FY17 to FY 2022, 60%, nice growth. And you can see the product mix. So that lighter blue color is 70%. That's the largest component. And then that ECP furnace and other is the darker blue. And then that aqua is advanced packaging and other. So here's some history going back to 1998, talking about innovation and customer design wins. And here's a map kind of showing what we already talked about, but the headquarters in California, but then it has an ACM South Korea, and then it has the manufacturing center in Shanghai, China. So here's the tier one customer base, some big names on here, SMIC, JCAP, HLMC, and so on. Now this stock reminds me a lot of ACLS. If you remember, we bought that in 2021 in Discord, and that stock has done very well. It's up 500-600% in just a couple of years. Now, of course, I'm not saying that this is going to do that necessarily, but it reminds me a lot of that company. It was about $1 billion when we bought it. It was kind of specific, niche focused in semiconductor equipment. So I look at semiconductor equipment and semiconductors. Semiconductors are the new oil. When you're looking at equipment like this is the pick and shovel play for all those secular growth trends we talk about, from artificial intelligence, autonomous driving, 5G, genomics, metaverse, and more. So their longer term target here is $1 billion plus in revenue, and you can see some of the guidance here, $550 million midpoint. And this is pretty strong considering it's just over $1 billion market cap. This talks about their growth strategy. So growth at existing customers, expanding more internationally, new capacity and new products. So looking at some of the results here, this is last quarter, revenue is up 38.5%, shipments up 37%, gross margin. Now the gross margin profile is maybe a little bit less on this than some of its competitors, but still pretty good at about 47.5%. That's GAAP gross margin. And you can see some of the other numbers on your screen. Key operational updates. So strong revenue and EPS as operations and industry supply chains largely returned to normal post-COVID. Now, of course, if you go into recession, semiconductors are cyclical. So this stock could certainly see more pressure, and there's also other risks we talk about like China. You can see here mature node spending by our China customers, market share gains and penetration from new products and new customers. Now, the one thing I'll say about this, when you think about the bands that we're seeing with NVIDIA and so on, those are advanced AI chips, so H100 chips and so on. This is cleaning equipment. So I think the chances of that are a lot lower, because they're not involved with actually actually producing AI chips. So it's a lot different story here because you're talking about equipment, but it's still possible. So it's something to at least be on your radar. These bans could impact a company like this. Now, if you look at China exposure, most semiconductors, many of the names that you probably even own, have probably a higher concentration or risk to China exposure than you might think. So it's going to be pretty much inevitable. Most semiconductor companies, or even the small caps, are going to have some Chinese exposure. And the larger they are, probably the more exposure they have. Now, typically, you know how I like to buy stocks. If you watch my masterclass videos, if you're an elite and you watch chart day every single Wednesday, we do chart day at 9 o'clock a.m. Eastern. You know, this, if you look at the trend here, this was down here $5.46. This was just October of 2022. The high up here, $20. That's a big move, you know, from the fives to almost $20 a share. So trading right now at $17.50 a share, you can look at a chart and say, well, I would much rather buy it down here. You know, the 200-day moving average is closer to $12. You got this 100-day moving average at $13.66. Your S3 pivot point under $13 at $12.98. Your S2 under $15. That's probably the range. If it gets down in here, that's the range that's very attractive. Now, with this company, this stock, it has momentum. And normally I don't like to buy stocks that are riding momentum like this. I like to wait for them to come back. And I think that's certainly a possibility. Now, with that said, I look at the valuation, the growth metrics. I bought a starter position. So I'm not going all in, you know, buy some in the 17s. If it goes down in those lower prices, that's what I want because I want to buy more shares. But there's no guarantee it's going to happen. If you look at the 12-month trailing P ratio, 17. That's attractive. You know, so this does have profitability. It has strong growth. It's not crazy expensive or overvalued, even at $17, you know, $18 a share. Now, with that said, you want to buy the best prices you can, and it was recently in the 15s. So if it gets back in there, that's the area that I think is more attractive. Let's look at some more metrics here. This is on Seeking Alpha. This is ACM research. So you got the PE non-GAAP TTM, 14.52. You got the PEG ratio. This is non-GAAP forward PEG ratio, 0.71. The PEG gap, 0.16. These numbers are very attractive. From a growth perspective, also very attractive. You know, Seeking Alpha rates it an A. You got revenue growth 49% here. That's year over year. You've got forward revenue growth about 37%. EBITDA growth 106%. And you can see the other numbers on your screen. In this last earnings here, this was just in August. EPS, you can see actual beat by 25 cents. And then revenue surprise beat by $29.79 million. Now, I also bought one more small cap semiconductor stock this morning. I'll share that later in the video. Next, I want to move on to PayPal. Now, if you're looking more for a value play in the fintech space, I think PayPal is a good option here. This is a 16.36 P ratio. You can also look at Square, but it's a very different animal because that's not profitable yet. I think Square under $40 is also attractive. It just depends on what flavor you're looking for. And they're both in the same space, but they're very different companies. So you look at PayPal right now, $57.38, down 2% today. You know, the 52-week range, you can see $56.53, so about $1 lower than it is now. And then the 52-week high was actually $95.57. This is about a $64 billion market cap. It has 2.32% short interest, so shorts are starting to get out of the name. You can see over the past 52 weeks, PayPal is down almost 37%. So price to sales ratio on this is about 2.3, price to book 3.28. Now this PEG ratio, if you get under a 1, that's generally getting pretty attractive. This is a 0.91. And then you got the PE. So this year's estimate, this is on Fidelity, 11.6, and next year's estimate, 10.2. So I mentioned earlier, we do chart day every single Wednesday, Patreon Discord at 9 o'clock a.m. Eastern. You can join us. Go to patreon.com/firedupwealth and join a leader higher. Now, this is a chart of PayPal here. You can see a previous chart day. This was a few weeks back, and we said that we could see $55 in the stock, and that's the level it's at now. Now, I know this is always hard to believe because you can look at these charts and say it can't go any lower. This is still in a downtrend, and it can actually go lower. You can see it's trying to form a base here on this S1. So that's roughly where it's trading at right now. Now, if you look at the S2, it's actually in the $54 range. This S3 is down here at $51.44. So is it possible that this stock could go lower? Could it go to $52? Could it even go to $49? I think the answer is yes, and the sentiment is that bad. But when you're thinking about a 5-year investment, and you think about how many people are in this network, how many millions of users PayPal has, the fact that it's profitable and it's not crazy expensive, at some point it gets to a level where it's very attractive. It becomes a value stock and it's hard to ignore it. But I think a lot of people just assume that it can't go lower. When it got to 65, it couldn't go lower and said it'd probably go below 60. No way. Well, here we are below 60. Now we're saying it could go below 55 45 or even 50, you say no way. It's possible. And this is why it's so hard, because if you're buying on a downtrend, you're dollar cost averaging, and it's very hard to do. It's very hard to time a bottom. So there's two mindsets. You nibble at prices you think are attractive and you know there's levels it could go to, or you wait for a bottom and you buy it on the way up on an uptrend. What I'm trying to do today is show you some opportunities, some ideas for prices that are attractive at these levels and lower. Of course, the whole market sells off and goes lower, stocks are going to go lower as well. So next, let's talk about Disney. Now, this is an interesting one, another one that could see more pressure. If you look at the stock, it's right now about $79.50 a share. So the 52-week low was $78.73. Again, we're really close to that number. 52-week high was $118.18. Now, of course, this is a large cap, $145 billion. And it's hard to ignore the fact that Disney, if you talk about companies that have a moat, Disney, in my opinion, has a very strong moat. Not only with the theme parks, cruise lines are one thing, but you talk about Star Wars and some of the intellectual property they own with Marvel, with Pixar Studios and National Geographic, and you start talking about ESPN, ABC. There's so much going on. Part of the problem here is streaming was so big. It pushed the stock, everybody's excited, and now we're starting to see that streaming is becoming really hard to do and to be profitable at. And of course, the pandemic really impacted Disney, and they've had a lot of ramifications from that. There's been a lot of drama behind it. I don't own the stock currently. It is on my watch list. I just think it's something attractive for you guys to look at. When they cut the dividend, that's a big deal, because right now you look at it, is it a value stock or isn't it? A lot of people would say it's still not, it could go a lot lower. It's not really a value stock. You could say, is it a dividend stock? No, it's not a dividend stock. Is it a growth stock? No. So it doesn't really have a home. You think of investors, they're buying one of those categories, and Disney doesn't really fit very well in any of those. At some point, Disney probably brings the dividend back and the stock's probably going to do well. If you look at 5 and 10 years out, companies that have strong moats that should do well over a period of time, I think Disney will. If you look at a chart, it's absolutely brutal. If you own shares of Disney, it's been years of poor performance to negative performance. Just to give you an example, guys, the last 5 years, it's down 30%, 31%. Of course, on a max chart, going all the way back to 1983, you're up 5,971%. But I don't think anybody watching this bought Disney stock October 14th, 1983. If you did, congratulations. So let's just go to $80 a share. This goes back to March 24th, 2014. You're talking basically a lost decade for this stock. Now, we don't necessarily care where it's come from. We care about where it's going. I don't think they're out of the woods yet, but if you start accumulating shares under $80 and you're buying your dollar cost averaging, you're thinking very long term, this could be an opportunity. The next stock I want to cover here is ASML. And this is a great pick and shovel play. You think of AI and you think of those mega trends. When you think of EUV lithography, they're doing things that no one else is really doing, right? So you look at this stock, 52-week range, $363.50. Of course, it's $576 now, but the 52-week high was $771. Now we'll look at a chart here in a second. I do think the stock could continue to see more pressure. I've been nibbling some shares. In fact, I bought a couple more shares today around this price. This does pay a small dividend, a little over 1%, and this is a $233 billion market cap. And the PE on Fidelity here is a 28.8, so that's certainly not cheap. Of course, that's 12 months trailing. Price to sales ratio, 8.32, not cheap. You look at the price to book, 20.14. This is according to Fidelity. But then you start looking at things like PEG ratio. So you start factoring in some of that growth, and now you're at a 1.27. Now you'd love to see that below 1, and I do think the stock could go lower, but this is attractive, even though the PE this year's estimate 28.8, next year's estimate 25.7. This is a high quality company, another one that's in the semiconductor equipment, but a much larger company, and it, in my opinion, has a monopoly really in what it does. So we talk about different types of growth stocks. You've got the hyper growth, you've got regular growth, you got mature growth. I would consider ASML more of a regular growth. This is solid growth, 34.73%. So not really hyper growth, but solid growth here, right? You look at the sector median, 9.25%. Now the forward revenue growth, you can see 13.8, and that's slowing down. Part of this here, you have Taiwan Semiconductor again. You've got some of these foundries that are delaying projects. That's going to impact companies like ASML because they're providing the equipment for those foundries to make those chips. Now, it's just a matter of time. So if you're a long-term investor and you've got a 5-year time horizon, I'm confident this stock will be worth more later. In the short term, it's really hard to guess where it's going to go. Let's look at a chart and see where the possibilities are. Okay, so ASML, you can see here, it got to the S1. This is around $566. It kind of bounced off of that, and it's struggling to really get momentum here. Now, it could, build a base and find a bottom and go higher. I think it's possible to see it lower. This S2 is 540. I think under 550 it gets really attractive if that happens. And this S3 is actually under $500, around $498 a share. So do these prices have to happen? The answer is no. Again, this is where it's really hard. It's hard to try to time a bottom. You're either going to dollar cost average or you're going to try to buy momentum when it swings back up. Now, I will say, if you look at this, it's below all the moving averages, and this Fibonacci retracement, this ribbon, this colored ribbon, when it starts to get down here, oftentimes these will kind of bottom out and go higher. It doesn't mean that it can't go lower, but I do like this stock in this price range right here, even though I think it can go lower. If it gets below 550, I buy more. If it gets below $500, I buy some more. If that doesn't work for you, you've got to wait. And then eventually it'll probably be back over $600 and you buy the momentum up. It depends on how you're trying to buy. I think, of course, as it gets lower, it's more attractive from the valuation. So this isn't a cheap stock, but it's a high quality company. It's in that Wall Street fashion show, and it's going to have buyers. It's going to be a higher priority name than a lot of other companies, especially smaller caps that are burning cash, not profitable, and so on. So this video, we could talk about tons of small caps and spec stocks that I know that a lot of you guys are buying, and I'm buying some of those too. Today, we're trying to focus on a little bit higher quality names, the ones that have that free cash flow, that are profitable, that aren't burning the cash. If we get into a recessionary type period, you're going to see a lot of pressure on those speculative names. So make sure the majority of your portfolio is high quality. Keep your speculative positions to small percentages, 5-10% of your portfolio max. So I've got 3 more stock picks for you guys. The next 2 I'm going to do in a kind of rapid fire type of a fashion. If you're new here, please do me a favor. Hit subscribe to the channel. Click that bell for notifications. If this video is helpful, drop me a like and drop me a comment. I do one of these videos at least once per month, top stocks to buy or best stocks to buy. So we've talked about Enphase plenty on the channel. There are a ton of videos on this channel covering Enphase, deeper dive, going into the fundamentals. Check those videos out if you want more information. We've covered this on many recent videos as well, talking about, I like these prices. I wouldn't be surprised if you see $100 or less. This is interest rate sensitive. As those interest rates climb the last few days, that's going to put pressure on names like Enphase and really solar stocks in general. It got down closer to like 110. And I do think it's possible again that it could go down to 100 or even less. And it's going to be really critical in earnings, and earnings season is coming around the corner. In fact, these guys are going to be reporting soon, I think October 24th. So just in a few weeks here, we're going to have earnings from Enphase, and that could make the stock drop or pop depending on that data. So you have to be careful, of course. I've been nibbling here. I think it's attractive. My cost basis is around where it's trading at now. I've been very, very patient with this stock, and I encourage you to continue to be patient with this stock. I do think longer term, it'll be a good performer, but it's not the right environment for this stock right now. So just to give you an example, I have something like 0.4% of my portfolio in Enphase. I want a minimum of around 1%, maximum of 2%. So if this does go below $100, that's where I'd be buying heavily and I'd have a bigger position. If it doesn't, high quality, problem to have. If it goes the other way, maybe I buy a few more shares a little higher than they are now. I get to my 1% and I'm still happy with that position in my portfolio. And that's why having that blueprint, that plan is so critical to help you decide what you're going to buy, when, and how. Now, Bank of America might not be a stock for everyone. Look at this 7.47 PE ratio. It pays a 3.7% dividend yield, and it's trading really at 52-week lows, 25.56, and it's trading just 20 cents higher than that right now. 52-week high was $38.60. Now, I'm typically not someone who buys bank stocks, but in both portfolios, the primary taxable brokerage and the community portfolio, we own some Bank of America. It's not a huge position in either of those portfolios, but I do think this is one of those banks that will do fine longer term. Banking in general is tough. There are a ton of banks out there. There's only a handful that are those huge mega banks that you just can't see going anywhere. You think of Bank of America, JP Morgan, there's only really a couple names that come to mind. Now, the price to sales ratio isn't that important on banks. What you're really going to look at most time is price to book. So you can see this is at 0.81 right now. So it's trading under price to book, has that nice dividend yield. And of course, PE, you've got 7.7 and 8. But the big thing here, it's under price to book at 0.81. And can it go lower? Of course, it can always go lower, but it's below all the moving averages. It's below this retracement, and it's sitting right above the S3 Fibonacci pivot point here. So can it break $25? Sure. But you're getting paid a nice dividend yield. It's not an expensive stock. And me personally, I'm not concerned that the company is going anywhere. So the 7 stock pick, this is the other small cap semiconductor stock that I bought a little bit of, just a starter position. So Navitas Semiconductor, NVTS. Now the 52-week range on this, guys, this was $3.11. And you can see it was all the way up to $11.17. This is one that I was researching last year. It just ran really hard, and I'm not going to touch it. Now it's pulled back. It's down almost 50% from the 52-week highs here recently. Now this stock is going to be more speculative because it doesn't have that PE ratio, and this is not a cheap stock. So this is going to be in your spec basket if you're looking at this one. And make sure with all these stocks, do your own homework. Make sure you buy what fits your blueprint, your needs, and portfolio. These are not recommendations to buy, just sharing what I'm buying and what I think. So this is a $1.17 billion market cap. Now this is going to sit either in your spec basket or hypergrowth bucket, depending on what you feel. I'm putting in my spec basket. It does have some pretty strong growth here. Revenue growth year over year, 90.72%. Forward growth, 82.14%. Now from a valuation, that's not good because we don't have profitability. And even though it was just $11, it's still really expensive. The EV sales forward is 12.99, EV sales 18.47, and that price to sales, the TTM, 19, forward is a 15.23. So I'm hoping that this stock goes lower. I think it's still pretty expensive, but I did nibble just a starter position, literally a tiny position, $2,500 worth, and I'm hoping it goes lower so I can add more shares. So if you're not familiar with what the company does, founded in 2014, this is a small company, 200 employees. Now I don't have a ton of time in this video to go deep on this. So if you want a deeper dive on this stock, let me know in the comments below. I'd be happy to do that for you. It has 185 patents pending. You can see this compound annual growth rate 150% from FY18 to FY22. So this is one of those hyper growth type stories that people are paying a premium for, and they believe in the future, and it's $1 billion company. So it's one of those things, again, spec, 10x or zero, but to go from 1 billion to $10 billion over the course of a decade, that's much simpler than if you're a $1 trillion market cap going to a $10 trillion market cap. That's not a reason to buy the stock. It's just some simple logic to see where small caps can be big winners in a portfolio if you buy them at the right prices, the right time. Now, of course, this is a company slide deck, so take it with a grain of salt, but they're calling themselves the only pure play next gen power semiconductor company. And you have all these different products and secular trends kind of listed in here. So again, semiconductors, the new oil, it's another one of those plays. When you think of electrification of the world, talking about energy sources, transition to clean, efficient, reliable, low-cost electricity for a bright and sustainable future, this is going to help with this. So talking about renewables here, roughly 40% CO2 emissions reductions by 2030. So this is going to be a semiconductor play that's also going to ride that secular trend of clean energy. So Gannon SiC wafers, perfect fit for fabless. And it will be interesting to see how this all plays out, because we also own a little bit of Wolfspeed in the Friedel community portfolio. It's another one that I consider kind of speculative, but these names are getting a lot of attention. And it starts to get pretty deep. I'll just kind of skim through some of these slides so you can see them. Pause the screen if you need to. This is an interesting company. I've been researching it for quite a while. I consider it more speculative. I think it's an opportunity. I think it can go lower. I'll look at a chart here and show you the possibilities. So it's trading under $6.50 a share right now. So it's broken down that S1. Looking at it this morning, if the market was going to stay green, thought maybe it would try to take over that S1 again. You can see it's below all the moving average. You got the 200-day moving average here above $7 a share. Move my camera so you can see that better. But this 200-day moving average, it's sitting here closer to $7.15, 20 cents. So it's broke this S1. This S2 is going to be closer to $6.16. This S3 is down here at $5.31. So someone asked me today, where do you think is a good price to dollar cost average? It really depends on the person. Now, if you look at this, it went from $3 back here at the end of 2022. It ripped up to $11 a share, and now it's pulled down, $6.40. So if you do the math on that, you've basically got more than a 50% retracement from this low to this high, and that's generally where it'll start to bottom out, but it can drift a little bit lower. So is it possible you see this stock, $5.31, maybe even down here, $4.83? I think the answer is yes. And I think that's the opportunity, because this is still an expensive stock. So if I were given advice, if I were your financial advisor, advisor, which I'm not, I would tell you if this stock comes down in these levels here, you know, somewhere down where this square is, this is probably the sweet spot. And there's no guarantee. Of course, there's people that want to own this stock. There's a lot of excitement around it, so it could find a bottom anytime. That's not a reason necessarily to buy the stock. So this is very expensive. It's speculative. If you're really wanting to get a better price, I mean, this was obviously a great deal at $3, and maybe it gets to $5. That's probably an opportunity. Can it bottom out before, you know, it gets to $6 a share? I think it's possible. I think it's something just to put on your watch list, guys. I hope this video is helpful. If you're new, make sure you subscribe to the channel. Click that bell for notifications. Drop me a like. Drop me a comment. Have a great rest of your day. Take care.